This video is packed with goodness, so let's jump in and get going. The first lesson is, unfortunately, you are likely your biggest enemy. It's called behavioral finance, and it's part of what it means to be human, right? We've all heard the adage, you want to avoid buying high and selling low, but how many times has that happened to you, right? If you're going to be an investor, it's going to happen to you sometimes, but you don't want it to happen too many times. And the reason it happens is it's just human nature, right? When things are scary in the market, when things are scary in the economy, we want to hide. Evolution has taught us to hide from scary things. And when things are good and prices are going up on stocks and the economy's doing well, we want to jump in, right? So we seek things that are enjoyable, obviously, and we hide from things that are scary. And that's helped the human experience, and that has helped human beings throughout history. However, when it comes to investing, it's hurting us. So that's lesson number one that I've learned from all of these books. Another important lesson is the difference between productive debt and destructive debt. Productive debt is when you're buying assets that are appreciating in value, that are cash flow generating, healthy cash flows every year, that enable you to do things better, faster, cheaper, enable you to do what you want with your life, right? That is productive debt. Buying your 20th suit or your 10th pair of dress shoes, especially if you're putting that on a credit card that you're not paying off, that's what I call destructive debt, right? It's things that depreciate immediately, right? If I buy a pair of shoes and a month later I decide I don't like them, I'm going to get pennies on the dollar, if anything, right? I'm probably just going to toss it in my closet because I don't want to admit that I made a mistake and give it away. So knowing the difference between the two, and there's not many guarantees in life, but if you want a guaranteed way to make an 18% return, oh my goodness, call the SEC. Azul's telling me I can make 18% guaranteed. The only way I know to do that is to rip up your credit cards. If you're paying 18% interest, 20% interest, 25% interest on your credit cards, rip up your credit cards, don't use them. I say that somewhat in jest, but what's the difference between having a $1,000 balance on your credit card that you're paying 18% on and taking money out of the bank that you're not earning much money on and paying that off, right? That's kind of an 18% guaranteed return. So that's the second lesson, is understanding the difference between productive and destructive debt. Okay, the third important lesson, Einstein called it the eighth wonder of the world, and that is compounding, right? The power of compounding interest, of compounding returns. You want that to work for you. A real common illustration of that is, I'm currently 58 years old. When Warren Buffett was my age, he was only worth $2 billion. Now, we'd all like to be worth $2 billion, but you know what? Now at 92, almost a quarter of a century later, you know how much Warren Buffett's worth? Over $100 billion. And he would say the vast majority of that is simply because of compounding returns. So the power of compounding returns, I say you need to spend less than what you earn so that you can save. And then it's not enough to save, you need to invest it so compounding can work for you. Because compounding will either work for you or against you. If you save your money, but you put it in a tool that, like a bank account traditionally, that earns less than inflation, compounding's working against you, right? It's worth less and less every year because it's not keeping up with inflation. So make sure that compounding is working for you. Okay, the next one is a part A and a part B. Number 4 is to understand taxes. Wealthy people understand taxes very, very well, and we all should understand taxes. Now, I know it seems like, all the nice tax benefits go to wealthy people, but that's not true. you can use fairly simple and everyday tools to have the tax code work for you, right? I mean, if you know the difference between a regular Roth, a regular IRA, a regular 401k, and a Roth version of both of those, that's job number one, is understanding that. There's also what's called flexible spending accounts, and there's two flavors of flexible spending accounts. There's for healthcare, and then there's for dependent care. Dependent care is most people think about it for their kids under 13, but it's also if you're taking care of any aging parents or any dependent that lives in your house. So that can be something that can save you taxes, serious taxes. Okay, also a health savings account, which is something that allows you to save up money. You get a tax break when you put the money in. It grows tax-free, and as long as you use it for qualified medical expenses, the cash flows, the distributions from that account, as long as it's being funded for qualified medical expenses, that's going to, that's really the holy of the holiest grails, because you get all three tax benefits when you put the money in, when it grows, and when you take it out. You do need to know that the healthcare flex spending account and the HSA, it's either or. And importantly, with the health savings account, there is no income limit, but there is you have to have a high deductible healthcare plan in order to do that. Okay, so these are very simple tools that you can use. And if you use all of these tools, I give an example in a video where I talk about how a family earning $120,000 a year can defer taxes on about a third of that income, which is really powerful, right? And as I said, there's a part A and a part B to this. I mentioned that wealthy people understand the tax code very, very well. And it's because it's worth a lot of money to them, but you know, it's worth a lot of money to you as well. Okay, so there's a gentleman, Robert Kiyosaki. He wrote the book Rich Dad, Poor Dad. And he has a framework. He says, you know, you're either an employee or you're self-employed. And in either case, you know, you're selling your time for money, right? An employee has a job, and a self-employed person owns a job. And Robert, you know, has a left and a right quadrant, and he would say both of those are areas that is going to be hard to get the tax code to really work well for you and to get freedom sooner in your life. So Robert would say he's got this left quadrant and this right quadrant, and on the right quadrant he would argue that's where you want to be, and on the right quadrant he has business owners. And business owners benefit because other people are working for them. So people are making their money. And also in that quadrant, Robert would say, are investors, where instead of people making money for them, it's investors making money for them. So I think it's a powerful concept. And I think that book, Rich Dad, Poor Dad, is definitely worth a read for most of us. So if you haven't read it yet, I'd put it on your short list. Okay, let's keep going. Remember, I said I'm breaking this into two parts. The first part is the takeaways, and then I'm going to go into some detail on the books. Like I said, buckle up because there's a lot of goodness in this video. Okay, the next concept is really the value of your time. And if you think about it, you know, let's use an example. Let's go for a walk. You're probably sick of me sitting down. It's such a beautiful day here. Let's go for a walk. But the value of your time, I'm going to use an example of a $40,000 car. You know, if you're making $25 an hour, you know, that's going to take 1,600 hours of your work to pay for that car. And when you factor in taxes, it's pretty much a year of your life going to buy that car. As opposed to somebody making $100 an hour, which they can pay for that in 400 hours, which is, what would that be? 1/5, 20% of their work life. But you got to remember, you know, if you're making $25 an hour. You don't get to spend $25 for that car, right? You've got living expenses, and let's say outside of car expenses, and it's pretty close. The average American, including transportation costs, which is about $1,000 a month, it's about $900 a month actually. They spend about $50,000 a year for living expenses. So let's say out of the car, it's $40,000, and that includes taxes as well. So now you have $10,000 a year of, discretionary income. What are you going to do with it? You're going to save it? You're going to buy it? So that $40,000 car actually takes 4 years of your life. So I really want you thinking about the time value of everything that you buy and put that in perspective. You're going to work full time for 4 years to pay for that car. Could you get a lot of the same joy and only work and buy a car that's $10,000 or $12,000? I've bought a lot of cars that way. Now I know I haven't bought a car since the pandemic started, so I know used cars are more expensive, but the base concept is still there. For many, many people, it's the least sacrificial way for them to be able to save more money and more importantly, to spend your time doing what you want to do. Do you want to work 4 years of your life to pay for a car, or do you want to spend 4 years of your life traveling the world, doing things with friends and people that you love and having adventures? For me, that's an easy decision. Okay. I'm going to jump into the books now, and of the 40 plus books that I read, I'm going to give you recommendations on 5 or 6 of the key books. But before I go there, hopefully you've been enjoying this video. If you have, as the kids say, thumbs for likes and subs for love and comments for me, Azul. So please leave a comment. I love reading your comments. It's frankly one of the big reasons I do this YouTube channel. Okay, books. I think the book Psychology of Money by Morgan Housel is an excellent book. I highly recommend it. I'm going to share with you a couple quotes from his book that I think are just golden. And really what I like about Morgan's book is he not only talks about the facts behind successful investing, but also the psychology and the behavioral aspects behind successful investing. So here's a quote of his. Spending money to show people how much money you have is the quickest way to end up with less money. I mean, that's really true. How many of us buy stuff because it's like, oh, my friends are really going to be impressed with, whatever, the brand new suit, the fancy watch, the fancy car, something like that. Another quote is, things that should never happen have a way of happening all the time. Anytime you do an investment and you tell yourself, oh, I just need this to work for another year or another 6 months or another month, I think the whole cryptocurrency in a lot of ways can fall into that. Yes, I know blockchain is definitely a transformational technology. Super important. It's going to play a big role in our future. But so many of these digital coins, how do you value them, right? So just be careful, because things that are never supposed to happen all the time. Look at what was supposed to be one of the lower risk investments on Wall Street prior to 2008, 2009, which was buying slices of other people's mortgages, right? That got sliced up and sold by Wall Street, and a lot of people unfortunately got hurt by that. Okay, the third quote by Morgan Housel I'm gonna give to you is, saving is the gap between your ego and your income. And I've already talked about that and the dangers of spending money to impress other people. Okay, book number 2. This is probably a book you've never heard of. It's called Mastering Market Cycles by Howard Marks. Now, Howard Marks is a debt guy. He buys distressed debt when the market is scary. So he's probably busy right now, right, with people worried about an upcoming recession. But he really talks about the opportunities that are available if you can control your emotions and not get scared by the market and see it as the opportunity that it can be. And, you know, when times are good, everybody says, oh, yeah, the next time the market gets scary, I'm perfectly fine. I'm waiting for stocks to go on sale. Well, It's easy to say that, but when your life savings has dropped 20, 30, 40%, it can feel really scary. It can be hard to fall asleep at night. You can have a knot in your stomach. And so Howard Marks' book, he's an excellent, excellent writer, and he just talks about market cycles and how to think about them. It's still going to feel very painful when you're experiencing one of the market cycles, but I think Howard Marks does a great job of giving us some things to think about, and it's best read before it's scary out there. So who knows? You know, as I record this, is a recession on the horizon? Is it not? Well, there's definitely a recession on the horizon, right? I mean, the economy doesn't go up and to the right forever. The question is, when is the next recession? But I think the best time to read Howard Marks' book, Mastering Market Cycles, is when things are not scary out there. I'll give you a couple quotes from his book. The greatest challenge to successful investing is controlling one's emotions. You guys know I'm a fan of that concept. And the next one is, being too soon is indistinguishable from being wrong. And what he means by that is, you know, there's people out there that I call perma bears. They're always bearish on the market. They're always predicting the next crash of the stock market. And you know, if you're 3 years too early, 5 years too early, 7 years too early, you can lose a lot of money, and or you can lose out on a lot of returns, right? If you go to cash because you think, oh, the US is going into a recession and I want to avoid that pain. Well, if you do that 3 years before you need to, you can lose out on a lot of returns along the way. And yes, you might be in cash when things get scary, but long term, are you really going to do better? I would argue you're not going to do better for a variety of reasons. Okay, let's keep going on this list here. The next book I want to talk about is the little book that beats the market. Again, this is a lesser known book. This is by a guy by the name of Joe Greenblatt. And Mr. Greenblatt is the manager of a fund called Gotham Funds. He manages about $5 billion. It's a very readable and humorous book, so I think you'll enjoy it. It's a quick read. You can easily read it in a weekend. Sorry, a train's going by. When it comes by, I'll give you a view of it. But let's keep going. The little book that beats the market. I'm not sure his little book beats the market, but it's got some good advice in there. And basically, he talks about, Greenblatt talks about what he looks for when he's looking at companies. Now, for the average investor, I think most people are much better off not investing in individual companies, just because it takes a lot of work to research companies. And are you willing to put in the amount of work that it takes to do that? Most people are not. But anyways, his book talks about what he looks for, which is really companies that have a high return on assets. So when they spend their money to buy equipment, to make the company better, faster, cheaper, provide better services to their clients, they get a high return on that investment. And then he looks at price to earnings ratio, and obviously, you know, that's kind of the price that you're paying for a company, and he wants to pay as low of a price as he can and have a management team that invests his money wisely. Let's see. Here's a quote of his that I love. Investing without a framework, and his framework would be that return on assets and price to earnings ratio. Investing without a framework is like running through a dynamite factory with a lit match. You might live, but you're still an idiot, right? So he feels very strongly, as do I, you need a framework. There's a lot of frameworks in investing that can work, but you need to believe in the framework and you need to have the discipline to stay with it, both when it's in favor and when it's out of favor. So that's a very readable book. Another very readable book and a famous book is called One Up on Wall Street by Peter Lynch. Now, Peter Lynch, his day has come and gone. He was a hotshot mutual fund manager for Fidelity in his day. And he ran a mutual fund for Fidelity called Magellan, which really became their flagship mutual fund from 1977 to 1990. And during that time, he got almost a 30% return per year over that, you know, almost a quarter of a century. And the assets under management, now this is people, a lot of this came from people putting more money in. Here's the train, by the way, going, there's the end of it. By people a lot of people putting more money in Magellan. But when he started managing Magellan, it was only an $18 million fund. And when he left in 1990, it was a $14 billion fund. So imagine the fees, assuming Magellan was 1% per year, and actually I think it was quite a bit higher. But at 1% per year, at 18 million, Fidelity had revenues of 180,000. So, you know, that barely probably paid Peter's salary, plus he probably had a couple people working on his team. And at the end, Fidelity at 1% was making $140 million on the fees alone. So that was a big deal. Peter's book is excellent. He talks about investing in things that you know. I think it's important to know what you own and why you own it. I also think it's important for you to know if what you own goes down in value, what information are you going to use to decide whether you invest more money. Gee, it's less expensive now. If you really like the company, if you really like the investment, maybe you should invest more, right? I'm not saying you should. This is just a framework that I think is important. A, I think it's important to know what you own. B, I think it's important to know what you're going to do or what information you're going to want to have if the investment goes down. What information are you going to use to say, I'm going to buy more, I'm going to leave my investment the way it is, or you know what, I was wrong and the company's not as strong as I thought it was. Peter Lynch would say the most important thing is to invest in a company that you know. So he uses an example in his book, like people that work in a shoe store investing in an aerospace company like Boeing, or people that work for an aerospace company like Boeing investing in a shoe company like Nike. He says, you know, that's crazy. The shoe people should be investing in Nike, and the aerospace people should be investing in Boeing because they know a lot more about the industry. Peter Lynch is highly regarded in the industry. Just a fun story if you're interested. He's also, there's an asterisk next to his name because he quit the game in 1990, and people say, you know, he wasn't tested for a long enough period of time. The joke in the industry is, you know, he was a chicken. The first year he had a negative year. Actually, ironically, his last year was a negative year. It was the only negative year while he was running the fund that Magellan turned in a negative year. So there is an asterisk next to Peter's name. But I'm a huge fan. I was a young person when like a teenager, or you know, maybe even 11 or 12, when Peter, let's see how old, I would have been a teenager, when Peter Lynch was starting to get famous and people were noticing his outsized returns. So I kind of cut my teeth reading stuff by Peter Lynch. Okay, let's keep going. Obviously, I'm a fan of Warren Buffett. I've talked about Warren Buffett on my channel many times. There's a book, I think Warren Buffett's letter to shareholders that he puts out, I believe it's every May. Actually, I'm sorry, I misspoke. His annual meetings are every May in Omaha, Nebraska. If you ever get the chance to go, I haven't gone yet, but it's on my bucket list, and I better get there soon because Warren Buffett is 92 and his business partner, Charlie Munger, is 99. So I don't have many more years to be able to see both Mr. Buffett and Mr. Munger, although I've met Mr. Munger when I was in business school. Super smart guy. Very impressed with him. But Buffett's annual meetings are super informative. There's a book called The University of Berkshire Hathaway that kind of summarizes the key takeaways from the annual meetings between the years 1986 and 2017. You can see recordings for free on the internet. I believe CNBC archives them. But, you know, this book is just an easy read, and it's a nice summary of the key findings and the key takeaways from each of those meetings. And then the next two books are books that Warren Buffett put on all of our reading list because he talks about them frequently. One he talks about a lot more than the other. The first one is The Intelligent Investor, which is a great book by Benjamin Graham. And The Intelligent Investor really talks about buying companies. They would say you're not buying stocks, you're buying companies, and I would wholeheartedly agree with this. Buy companies that are trading at a discount, so you're buying them for less than their intrinsic value. And then they talk about, Graham does a great job of explaining the irrationality of the stock market in general, right? Over the long term, I think the stock market gets it right, the pricing and the value of companies. But over the short term, there's fear and there's greed, as I talked about earlier. And that can lead to mispricing. You know, you look at some of the dot-com companies in the late 90s and how crazy their valuations got. So clearly Wall Street gets it wrong. And Benjamin Graham uses the example of you've got this crazy neighbor that every day comes over to your house. Graham calls him Mr. Market. And every day he comes over to your house and he says, you know, I'll either buy or sell your house at this price. But, you know, some days he's had an extra cup of coffee and he's in a good mood and maybe he prices the house high, and the next day he comes over and he's grumpy. You know, he and his spouse got in an argument. And so he gives you a low price, and Graham uses that as an analogy for the market, right? And what do you care if you're going to live in your house for 20 years? What your happy or grouchy neighbor by the name of Mr. Market thinks your house is worth. So it's a great analogy. The other book that Warren Buffett talks about a lot is called Common Stocks for Uncommon Profits. And that's written by a guy by the name of Philip Fisher. I believe it was written in the 50s. But Philip Fisher really is the gentleman that, you know, Berkshire Hathaway is a fairly concentrated portfolio. It does not have thousands of companies in their portfolio. And Buffett would say that the idea of having a handful of great companies really came from this gentleman, Philip Fisher, and you can read his book, Common Stocks for Uncommon Profits. Okay, let's keep going, but I have another request. If you're enjoying this video, if you're hanging with me so far, you got to give me another like. Or if you've already given me one, that's fine. You just give one. Don't hit it a second time because the like will go away. And if you're still with me after 27 minutes, please consider subscribing. And also definitely leave me a comment and say, hey, Azul, you know, I made it to minute 28. And I still have some to go here. So I'm going to share with you next my favorite book, my favorite business book, I should say. And it's by somebody that we all know, Phil Knight. We may not know his name, but we definitely know his company, Nike. And the book is called Shoe Dog. And I love this book. In my opinion, it's the best business book written by the founder of a company. And I love the fact that Phil Knight built such a great company and such a valuable company. But to just show you the tenacity of Phil Knight, he claims he wrote this book himself. And he went to Stanford. They have something called a Fellows Program, where they invite back successful alums and successful CEOs to come spend a year, come spend, you know, an entire academic year at Stanford. You can sit in on any classes that you'd like to go. I'm hoping that that would be like a dream year for me in retirement. So admissions crew at Stanford, if you're listening, I'd love to do that. But Phil Knight did that. I know people that were in classes where Phil Knight was in. He mostly focused on writing classes. And he used that year to become a better storyteller, to become a better writer, to become a better author. And his theses, his magnus opus, from a writing standpoint, obviously his life's work, magnus opus is Nike, the shoe company. But from a writing standpoint, Boy, the book that he wrote is just outstanding. And if you thought today's video was outstanding, I have two other outstanding videos I think you'll like. This video up here, which talks about average income in retirement, and this video down here that talks about 5 reasons to retire as soon as you can. Thanks for watching. Bye-bye.